Do you know that since Bitcoin's 2009 inception, hundreds of other cryptocurrencies have emerged and become often mentioned in financial news headlines? The 5 highest valued cryptocurrencies at the time this video was created had a market capitalization of more than $140 billion, attracting the interest of both financial institutions and central banks. This is because they have cutting-edge technology underpinnings and the potential to displace current financial institutional frameworks. We provide a non-technical knowledge of the concept and current market structure of cryptocurrencies to researchers in the fields of economics, finance, mathematics, and computer science. But before we go any further, spare just a minute of your time and like this video, and also subscribe to my channel. This will enable you to receive updates whenever I upload a new video. Through digital currency exchanges, various trading organizations can trade cryptocurrencies, an electronic medium of exchange. Over the past 10 years, there have been an increasing number of cryptocurrency exchanges as a result of authorities in many nations around the world struggling to understand the need for suitable investor protection rules. There isn't a single organization in charge of registering these exchanges, but it's thought that there are currently up to 500 of them operating. These exchanges differ in their platforms, geographic reach, and adherence to legal requirements. Forex and equities markets both have several features in common with cryptocurrency markets, including limited order books, matching algorithms, and exchanges that can be centrally or decentralized. As these markets are still developing, their future shape will be determined by a combination of consumer, investment community, and international regulatory acceptability. Cryptocurrencies stand apart from every other alternative currency or digital currency for that matter because they are a sort of medium of exchange that, in its basic form, does not require a central authority to conduct transactions or regulate the money supply. This degree of decentralization was made possible through cryptography. It has two primary purposes. Number 1, to keep the identities of market participants a secret. Number 2, to verify the transactions on the market. This enables users to safely exchange money without the requirement for supervision from a trustworthy third-party agent. The various cryptocurrency types could be consolidated into 4 by me. The 4 basic categories are utility, payment, security, and stablecoins. Additional token kinds include DeFi tokens, NFTs, and asset-backed tokens. Payment and utility tokens are the 2 cryptocurrencies that are most commonly used. These lack regulatory support and investor assurances. The mechanisms powering cryptocurrencies. The cryptographic nature of the underlying mechanism which enables these currencies to be decentralized is the key technological aspect that sets cryptocurrencies apart from other digital currencies. The only currency that permits direct money transfers as of right now is Bitcoin. What actions are required? Cryptocurrency is a fixed value object that is represented as a chain of digital signatures across the transactions in which it was used. A data pattern is a set of digital signatures to which a digital value has been ascribed. Since it uses a method to avoid double spending without the necessity for a central counterparty, it differs from other useless data streams since it is under a system with a central authority, and everyone can view the balance of a user's account. Addresses, which are long strings of characters, are used to identify users. These represent the public part of public-private cryptography keys. A signature is a personal item that only the user has control over. Because no external party is integrated into the system and just the participants' addresses are utilized to identify them, the participant's pseudo-anonymity is preserved. A participant advertises the message instructing the recipient to remove a specific number of tokens from her account and add them to another address when she transmits some tokens to another participant. The new transaction generates a hash that both identifies the previous transaction and contains the data from the message. This allows for the identification of each token's place of origin. The communication is then enhanced by a user by adding a digital signature, which is a code created cryptographically from the message and private key. Such a transaction is received by a network. After receiving the message, 3 steps must be completed before the transaction may be considered complete. How does blockchain work? The data or ordered transactions are grouped in a chain of blocks, which is what gives the blockchain its name. The verification mechanism used defines how safe the data is, and once it is added to the blockchain, it cannot be modified. The cryptographic linkages between the blocks produce a history of all prior transactions. Any computer system can participate in this peer-to-peer network as a node. The number of inputs and outputs for each transaction determines how much data is in each block. Each block consists of a header and a body where transactions are stored. The header contains the hash value of the chain's previous block, the hash of each transaction's hash within the block, and the bit field of the current target value, among other identifiers. Before a block may be regarded as authentic, a computer must successfully perform a mathematical challenge to find a block's header hash that is lower than or equal to the current target. One can view the whole history of every transaction that has ever been performed by obtaining cryptocurrency software and combining all of the blocks. Since there is no centralized authority, the community is in charge of uploading the data to the blockchain. This position is for miners. Their sources of income are the block reward, newly minted currencies, and/or transaction fees, if any. Only if the block is added to the network does the miner receive a block reward. This procedure encourages nodes to function in a manner that is valued by the majority of miners, while punishing nodes that attempt to behave dishonestly. As a result, the creators of the invalid blocks never get paid. On the other hand, the transaction fee varies and is entirely discretionary. The choice is made by the transaction's author if they can do so. The blockchain centralization. We can now look at the relationships between the key players in blockchain governance after defining them. When assessing the networks built by miners, scholarly literature frequently focuses on one factor: how decentralized they are. Following the advent of Bitcoin, scholarly literature did not address cryptocurrency governance for a while. As a result, a binary understanding of money was developed, with completely decentralized Bitcoin at one extreme and centralized processes supporting traditional currencies at the other. In practice, blockchain-based companies are more likely to fall on one of three primary decentralization spectrums: centralized, decentralized, and distributed networks. Centralized network. In centralized networks, a central node acts as the focal point for all communication, with several peripheral nodes being connected to it exclusively. These networks are not especially innovative in terms of governance, and the majority of cryptocurrencies do not want to follow this path. The technology behind blockchains may be useful for revamping centralized networks, despite rumors that central banks may create their concentrated coinage. Deployed network. Distributed networks, on the other hand, consist of a group of nodes that are all connected. In this idealistic network design, all nodes have the same level of authority and no middlemen are needed to complete transactions. Bitcoin is. Nakamoto believed that the Bitcoin network would be egalitarian and self-governing. Nevertheless, Bitcoin has drifted away from this network topology for the reasons we discussed below. Decentralized network. Decentralized networks exist in the space between distributed and centralized architectures. However, some nodes within the network can function as intermediaries for transactions in the absence of a central node, with complete control over the blockchain in these networks. The blockchain does not provide nodes equal power, which is another way in which these networks vary from scattered networks. Nowadays, the bulk of cryptocurrencies functions according to a similar theory. Finally, don't forget to leave a comment in the comment section. Let's have your take on this. Don't forget to subscribe, like, and click the notification bell for more videos like this. Till my next video, goodbye.